Well, thanks for taking the time to watch this. This is the 2026 Fall Crop Insurance Update. I'm Corey with KW Insurance. And first off, I'm just going to quickly go over if you're a Subert customer or you wonder what's going on with that transition. Russ and Tammy are going to retire from Subert Insurance on October 1st. We are going to assume those policies from their agency. We're actually a Farmers Union agent as well, so that'll be seamless. And then, as always, we are going to make sure we review things with you guys before the September 30th deadline to make sure you're set up correctly in your crop insurance. And then also we'll review your home, auto, and farm policies as they renew or anytime you want to sit down and go through that as well. So we're excited to work with you guys. That Subert location will be closed starting October 1st. You'll just come, if you want, in Shelby to our Shelby office, which is in the USDA building, or to our Sunburst office, which is 4 miles south of Sunburst. Or we're always glad to run out and meet you guys as well. So what do we have to offer? So these are the agents now that are employed through KW Insurance. Wendy and I are still here, of course. And then in Shelby, we have Teresa Bainey, which we're just going to go through these in order up top. My laser pointer will show up here. So Teresa Bainey, Renee Manley, and Leanne Apley, they're all doing the property casualty liability type insurance out of Shelby. They're sort of focused there. The crop insurance is more focused in Sunburst. But we can do either from either location. So if you guys need any help, just please feel free to stop by either one of those locations. In Sunburst, we have Darcy Fairhurst and Lynette Glico. Those two have been with us a long time as well. And then we were lucky enough to just pick up Shane Berthelot. He was working more in the tech sector of things, very good on computers and data mining and stuff for us, but also going to be an excellent agent. So he'll be taking his test to become an agent this fall. Then we had a wonderful young person named Adele Lamb that was a Shelby graduate that now is working in the Sunburst office as an intern and will work her way up towards becoming an agent as well. So we're excited. We got a really good staff. I think we've got a great team here that can help service your guys' accounts. Like I said, that Shelby office is in this USDA building, the same place that you guys would go for the FSA. You just turn left instead of right, and we're on the other side of that building. So farm property and liability insurance. We're currently in what's called a hard market, which means all of these companies have had poor loss ratios, which means they're losing money probably every year in this environment where there's been so many fires and natural disasters, and then we throw inflation on top of it. It makes it harder for you to get a quote from a different company, or within the company that you're with, they become more picky on things like roofs that aren't perfect or stuff that's laying around the farm. So obviously weather, inflation's a big part of this. Reinsurance costs. So the insurance company itself, like Safeco, buys reinsurance from a big, what's called a reinsurance company, and that's insurance for the insurance company if it has losses that are beyond what it wants to absorb. So the costs for the insurance company itself have gone up as well, which is part of the reason your rates have gone up. And then extreme weather frequency, of course, that's ramped up over time here. It's just part of what's happening. And then a claims history. So they're way more picky on even little claims on your account, make you less desirable than someone without as much claim history, right? Which has always been the case, but it's obviously they're more picky now than they used to. So what can I do? First thing, don't have losses like we did on the farm, or you can see I burnt this side by side up. But if you have a loss, that's what the insurance is for. But what a lot of people have shifted towards is raising their deductibles. So the average deductible on a farm now is probably $2,500 to $5,000. You raise those deductibles, and that avoids all those small claims. Plus, it gives you a pretty decent reduction in premium, and so that'll soften some of the blow on these increases. Requote. We can obviously try and requote you through different companies. They're all in kind of the same ballpark as far as the experience they're having, but there can be some substantial differences depending on where your farm's located and which risk area that company wants to take on. So it's well worth trying to requote this stuff if you think it's out of whack. And then pick up around your farmyard and fix issues with buildings. That's another big thing that is a focus of these insurance companies, is doing inspections to make sure they're not insuring something that has a high risk of a claim anymore. And then consider self-insuring stuff. So if you have things on your farm policy that maybe now you've increased your deductible to $5,000 and this piece of equipment's only worth $7,000, is it worth paying $100 a year to maybe get a $2,000 claim out of that? So consider some of the stuff that you think is very low likelihood of a loss, or that's more premium than that's worth paying for shallow loss. Then eliminating some of those could add up to thousands of dollars in premium on a big farm too. And then just prepare to pay more in the future. That's just where we're at, unfortunately. If inflation keeps going the way it's going and the loss experiences stay up and the cars get more complicated, all of that stuff is stuff that just increases your premium. So this is the only slide I'll have in this presentation on LRP, because that's more livestock focused, obviously. But what this allows you to do is buy a subsidized put a bottom on this cattle market. And last spring we said, what are the odds? We're above record highs at that point. What are the odds of this thing holding on? Well, it's skyrocketed still, and now we're up at 360, which is about a buck above the old record averages. So I would strongly consider giving up a little bit of your margin on those cows to put a bottom on this market. And this is a great way to do it, where you keep all the upside. You just give up just a little bit of premium to limit the downside. And if you preg checked your cows this fall and you already know where you're at roughly for calves next spring, I would strongly suggest getting in this sooner than later, because who knows when this thing's going to start to come on corked. But right now, phenomenal time for the cattle guys. And if you're more interested in LRP, I got a whole presentation on how that works. I'd be glad to send that to you. So it's a tale of two farm economies, right? We've got cattle and calves up 200% above what their net farm income was just a couple of years ago. Probably more than that now, because this was a 2025 slide, early 2025. So I'd say it might be 250% or more. And the cow and calf stuff, corn and soybeans down 45%. That's actually worse yet, probably, than what it was when we had this slide done. So a tale of two economies. What's propping this up on the net farm income is the livestock. So the pigs, any protein-based thing, pigs, chicken, cows, those are all up. Feed sources, wheat, barley, corn, all of that stuff is down, right? So the other thing that propped it up for 25, as you can see, it shows an increase in net farm income, which would be surprising to you guys in the grains, is the disaster money that got injected into these farms. So we had about $30 billion of disaster money that's in the process of being dispersed out into 25, and that's artificially propping this up too. But we know it's tough in farm country, right? So claims reminders, just we're able to we're set up now to print claims checks at our office through NAU. So once your claim's finalized at the office, we can get you a check that day. If you're through RCIS, if you want that quick a service, we can get you set up on ACH. Either way, we will get these claims finished as quickly as possible and get your check in your hands as quick as we can. Call us if you feel like your claim isn't going well. That's a big deal. Now, granted, we're not supposed to be in the same room with you and the adjuster, but we certainly can take a call on questions you have or complaints and help sort things out. So please always let us know if you're having any issues. Like I said, ACH is also an option for lost payments. If you want direct deposit, we can set that up. Then make sure you have bin samples submitted for each bin if you think there's even a remote chance you have quality issues. And if there was ever a year that would be the case, it's this, where we got multiple inches of rain on some pretty mature crop at harvest. So even if you thought you had a pretty good crop, like you're just a ways above your guarantee, if you binned all that production, have the adjuster turn in a claim, have the adjuster come out, pull those samples. So you might find out some of that wheat has mold damage or sprout damage, or even low falling numbers is something we can consider in here, and it very well could kick you into a claim or make your claim pay out better. So always take samples if you have bin measurements, and always make sure they take an accurate test weight. The other thing that can happen in a claim is the adjuster might be in a hurry and you just measure all the bins and he doesn't take his little cup out and do actual test weights of your samples. Test weight can make a huge difference in how much grain actually is in that bin when they measure it. Especially in hot years where you have low test weights, make sure when the adjuster's there that you pull test weights, and that's part of what's being done. More ideally, if they're measuring your bins, have them pull samples and send them to the state. It's only $30 a sample. So, and then October 31st is the end of the insurance period for most crops. It's actually September 30th for some of the pulse crops. So if we get late in harvest, that date becomes pretty important, because we're supposed to have someone come out and appraise your crop once the end of the insurance period hits, or get an extension. So we'll watch that for you guys this year. That's not going to be an issue. So common crop insurance options. You get these apps, and as you can see here, like where my pointer's at, we've got wheat. We're in revenue protection at 75%, but then after that, there's all this gibberish, right? So this is an NAU app. This is what it would look like through NAU. The options will look similar through RCIS or somewhere, but what we have here is, it says ETWOYAYCYE, right? And so what I'm going to do is I'm going to walk you through what all of these things mean. So the first thing is, that first thing on that NAU app is your unit structure. So OU would be optional units. That means we can break your payment level down all the way down to the section level by crop if you want to. So that's the smallest but most expensive setup we can put your insurance in. Basic units means that either there's not 2 units of the same thing, so you're not in optional units anymore, it reverts back to basic with the discount, or if we actually elected basic units for you, it would only break your stuff down to share level and crop level, not down to the section. Now the most common thing anymore, because it's subsidized so highly, is enterprise units. And if you're in enterprise units on wheat, it should never say EU. We'd always want it to say either ET or one of these other options, but most common would be enterprise units by type. And what that means is it's going to keep the spring wheat, the winter wheat, and the durum separate. If you're looking at your app as part of this and you see EU on there for wheat, we need to make sure you change that to something else. So EU just keeps all the types together. So that would combine the spring wheat, the winter wheat, and the durum. There's really no reason it should say EU on any of these crops anymore, because if we screw up and we only seed one section of spring wheat, by default, that's going to kick it back into an enterprise unit with the winter wheat in the first place. So we always want to elect ET or one of these other options, but not EU probably. EI is enterprise units by irrigated practice. What that will do is it will split your wheat from irrigated and dry land, but it's going to throw the types back together on each practice. So if you had irrigated durum and winter wheat and spring wheat, it's going to throw all those types together, but it'll keep that irrigated stuff separate from the dry land. And the same thing on the dry land side, it'll throw the types together, but keep it separate from the irrigated. So that's an option for some guys. When we're planting your stuff, it might be, hey, I'm going to do all irrigated winter wheat, and then I'm going to do all dry land spring wheat. And if that's your plan, it makes more sense to do this EI thing for some of you guys than it would the ET. Because anyways, we can get into that in more depth with you as individual customers, but there's reasons sometimes to elect enterprise units by irrigated practice for sure. So, and then EIEIO, right? So EO will separate your units by organic practice. So if you're organic and conventional farmer, we can have the enterprise unit discount, but have it separate those two things. Most common with a guy that's mixed is that we try to plan the organic crops to be some other crop than what you're growing on the conventional side, so we keep the separation there, but we can keep the types separate. So like I said, enterprise unit by type, by far the most common. Winter option, you always want to take this in the winter wheat. Probably a once every 10 years thing this happens, but if you have a situation where your winter wheat fails completely, if we don't pay the extra 10% for this winter option, you're forced to reseed that winter wheat to spring wheat. And if we're in a real drought situation where you'd rather fallow that, or maybe you want to seed it to a crop, it's getting late and you want to just spray the winter wheat out and seed it to lentils or barley or some sort of shorter season crop. If we don't have the winter option part on there, we don't have that option, basically. So always take winter option. If you don't, then you're stuck with the replant payment and you're stuck seeding spring wheat. 90% of the time, it's not going to be an issue, but the one time it is, you're going to be really happy you did it, so you could take all the money out of that winter wheat and maybe seed another crop that's not insured after it. So you must seed by October 31st for that winter option to apply. So if we get past that date seeding winter wheat, you no longer have that option either. So YA, so that means yield adjustment. So that's the next option on the thing we were looking at. And what that means is if your production falls below 60% of the county average in any given year, this thing will go back and replace that poor yield. So you can see we had 11 bushel yield here where my pointer's at in 2023 on this crop. It's going to go back and plug in 17 bushels for the YA yield, because 17 is 60% of the 28 bushel county average or T yield up here. So that election is on there to soften the blow in these bad years. That's a good thing because we've had a lot of bad years, and at least like in this scenario, we're getting 17 plugged in instead of the 11, right? If it was 0, it'd still be 17, basically. So that's that. YC is yield cup. That means your yield won't drop more than 10% in any given year for your actual approved yield thing. And then YE is yield exclusion. So this allows us to throw out yields in years when the county's below 50% average. We can go comb through your database and say, hey, for whatever reason, the county was below 50% average, but my farm was pretty good. If that's the case, we can elect to exclude those. We can have them remain on your history if you want. But for most of you guys, if the county's below 50% average, you're probably going to be happy to get that year thrown out of your database. So that's what that is. Now I should explain we have all these options on your insurance. They all cost you something if they're used, but they only charge you something if it's used on that unit. So it might be you had 1 unit of wheat this year when the county was below 50% of average. If we apply that to that unit, you only get charged that on those acres when that unit is seeded again. It's not like we were paying for this every year. But in enterprise units, because it's subsidized so highly, you might as well put as many options on as you can, because 10% more on a $2 and some cent premium like on dryland is not very much money to have some of this stuff prop your APH back up in these bad years. Quality loss, another thing that will happen is, like, was a malt unit, really poor yield to start with. So you can see we were at 15 bushels over here for the yield for the barley, but then it didn't make malt, so it also got a yield reduction in the malt endorsement side. So for the claim, it plugged in 11 bushels for our claim. If we have this quality loss option, it'll go backwards and find any years where we actually had yield reductions to pay us more in the claim and reset the yield back to what we actually cut. That'll be a big deal this year with wheat too. If we have some falling numbers issues or some sample grade wheat from all that rain, they very well might cut your production down 30% from what you cut to get you into a claim. But if we elect this quality loss thing, it'll bump it back to where you were for the bushels you actually cut. If we don't do that, we have to use a reduced yield for our averages too going forward. So, and then CP. So CP is contract pricing. That's really important if you're an organic producer. That should probably be on every crop that you have on your insurance if you're organic, because that allows us to use the contract prices on your organic market to increase your liability. So if you're organic, make sure it says CP on there. It doesn't hurt anything. If you're not organic, you're never going to get charged for it unless it's used, but very, very important if you're organic guy. And then the malt endorsement. I'm a big fan of this. You'll hear a lot of agents say you're better off in yield protection and then using that with contract pricing to put your barley contract on there. You can do that as a conventional guy too. There are so many scenarios now with the weather being so erratic where the malt endorsement might double your loss payment for 2 reasons. If you're in contract pricing, you have to be in yield protection. If you're in yield protection, you don't get the market moves that will trigger losses or increase losses. You also don't get the reduction in bushels that you get with the malt endorsement if your stuff doesn't make malt. So we've had scenarios where it's been 6-figure differences between being in this malt endorsement and not. So if you're consistently a barley grower, that's a big part of your operation, I would strongly consider getting out of yield protection and getting in the malt endorsement. The other thing is you'd be in revenue protection then, and that would allow those SCO and ECO, the county-based programs, to trigger way more consistently if you get the market moves where you wouldn't be in contract pricing. So quality issues. Once again, just a quick reminder, always have bin samples taken on years when there's potential for quality issues. I would go as far as saying, if you have a loss or you're going to have adjusters come out and measure your bins, always have them pull the samples for those bins and send them off. There's a lot of times we end up with surprises that stuff that's binned, like, hey, I didn't know the falling numbers in this wheat were 200, or that these lentils were sample grade. They look fine to me. If we don't send that off within 60 days of harvest, let's say the adjuster measured those bins, then you settle your claim, and then you deliver those lentils like in January, there's no fixing that on our end if it's sample grade. So if you're going to have some bin production, make sure somebody pulls a sample and sends that off. The adjuster needs to pull the sample, but they'll send it off to the state. It's going to cost you $30 a bin. It could make thousands of dollars a difference per bin difference in the claim. So, and then turn in a claim if you think there's even a remote chance of a loss. It's no big deal to turn a claim in and sign off on it later. It's getting very, very difficult to turn in claims late. So in that lentil example, if you were delivering in January and then we find out there's all these issues with the lentils and your production is not what you thought it was, if we've waited that long after harvest, it's very possible anymore we won't be able to submit the claim period. So if you think there's even a chance, turn a claim in, right? If you don't want to go through the hoops of completing the claim, if you get to December and you're like, no, I'm sure this stuff is not in a loss, you can only sign one piece of paper and release it. So what are the things we get for grade reductions on wheat? And so we've got, if it's US number 5 or worse, test weight 50 or below. Now, test weight's going to reduce your bushels in a bin measurement regardless. If it's 55 pounds, there's less bushels than 60, right? But if we get below 50 pounds, then they'll start reducing your production farther yet. to make up for that, because that probably kicks it into sample grade or something too. I haven't looked on the grain standards, and then defects are a big thing. So if you have mold damage on barley or mold damage on wheat, that can kick you up into sample grade, or at least it's a damage thing in the chart. The one thing we don't have on wheat is protein, right, for a discount factor, and we're probably never going to get that because there's so many variables in that. But if you have bad falling numbers on wheat, that's another one this year where we can get you into a discount. So here's an example of how this would pay. So we've got a 40 bushel average winter wheat yield. We take the 75% level, so that gives us a 30 bushel guarantee, right? If we take the 75% level on our insurance, we have 30 bushel guarantee. $6 base price, which is what it was this year, so $180 an acre guarantee on the crop insurance. You go out and you harvest 40 bushel wheat, so you had a good crop. We were at our average. And so you're like, I don't think I have a claim here. Well, what can happen is two things. The revenue will drop, like in a year like this, which could trigger a claim for you. And then we have another issue where we have a quality issue in this example. So our falling numbers came back at 220. The price drops to $5 at harvest. So we got two variables here. And then the first thing the adjuster will do after he measures your bin, and he'll go to these quality charts and say, well, that State Grain Lab sample came back at 220 in this example. For below 224, they're going to take away 14.2% of your production. So right off the bat, those low falling numbers then are going to reduce your production account for the claim by 5.7 bushels. So we've got about 34 bushels left of the 40 that would actually count against us in the claim. So same thing, we got that same guarantee, but you harvested 40 bushel wheat. You got the 14% reduction, so now they're only going to count 34 bushels for the claim. Plus the price went down to $5. So the production that you harvested is only valued at $5. So that gets us down to $171 of value. This is a shallow loss example. This can amp up pretty quickly, but $180 guarantee, $171 value for the claim, so an $8.50 an acre loss, basically. So there are so many scenarios where guys leave money on the table because they don't do the $30 bin sample and make sure they catch this, especially if you're on the edge of a loss. Now, if you deliver to the elevator, they're going to pull samples. That's a disinterested third party. We can use that as part of the samples for this claim. But if it's going to sit in the bin a while, you can have it measured, get samples pulled. Pea and lentil quality adjustments, they're so much more straightforward because they just take whatever the number 2 price is for the pulses and divide it into the number 1 price, and that's how they're going to reduce your production. So here's an example. U.S. lentils are number 1 at the elevator, 25 cents a pound. Your lentils grade U.S. number 3, so they only pay you 15 cents a pound for them. You harvest 10,000 bushels of lentils. As long as it's one of the quality factors they use for these pulses, then they'll take the 15 cents, divide it into the 25 cents, and that's what your bushel reduction will be. So in this scenario, we got 60% of the price that we should have if they were number 1s. So your 10,000 bushels is now, they're only going to count 60% of those bushels, so only 6,000 bushels to count for your claim, which then increases your loss payment proportionally. So that's pretty sweet, because whatever you're losing for grade discounts at the elevator is just directly getting made up for on the bushel reduction on your crop insurance. But remember, all of this must be done within 60 days of harvest. So make sure you guys get samples pulled within 60 days of the harvest of that crop. So peas are another one. We could fall into some weird RMA issues if you finish harvesting the pea crop, let's say the end of July, but harvest strung out till November or December or October even for the rest of the crops. If you didn't turn that claim in on the peas and get the sample pulled, we're already past 60 days from the end of harvest on that crop before you were done harvesting the rest of your stuff. So you finish crops up. If it's going to be a while before you finish the rest of harvest, it'd be good to have the adjuster come pull those samples at least and get them sent off. So important dates. This is the one that could catch people this year if we're having cash flow issues, is the termination date. So you just got your crop insurance bill probably. They were extending that due date with no interest up till November 30th during COVID and stuff. That stopped a couple of years ago. So now they've reset that, and your premium's actually due September 30th. If you don't pay it by then, doesn't mean your coverage is going to terminate until you get to November 30th. If you don't pay it by September 30th, that next month, 1.25%, I think it is, interest attaches, and then it'll do that every month. But if we get to the end of November and you haven't paid that premium, especially the wheat premium, then your policy will cancel, and we don't want that. So the termination date's November 30th. That's a good one to remember. And then the last day to seed winter wheat's November 15th. So you have a large window to get winter wheat seeded in here without a yield penalty. But if you get past October 30th seeding winter wheat, you actually lose the winter option. But still, big window time range in there to get winter wheat seeded without a penalty. So how did 2025 stack up in comparison to the previous years? And for the most part, it's better than 24 for a lot of guys around here. For some of you, you had really good crops that got a lot of rain at harvest. That's not so good. For us in Toole County and along the High Line, some of us fell into an area where it hadn't rained all the way through about the middle of June, and it was too late to save some crops. But if you seeded later, you had fallow, those sorts of things, those crops really shined here in 25. Bad news is that we are still in a D1 drought here in Toole County, and actually part of it should be worse for sure, I think. So we've had, at this time of year, I always roll up these drought maps, and since 21, we've been in a D1 or worse drought every year at this time of year for the last 5 years. We're approaching about a 10-year drought cycle here on our area, on our farm. So hopefully we're breaking that cycle. For those of you east of about Liberty County, so you can see in this drought map, things did improve pretty substantially from what they were back in 2001 and forward. So good news, though, about the drought map is that Toole County wasn't a D2 drought for about 10 weeks, it looks like. So that would put us into some of the drought disaster programs once we hit that threshold. We never did quite hit a D3, but we were in D2 long enough. I think at least we'll kind of hit some thresholds on those programs if there is any. So better than 24 for most. Revenue claims possible. The price not better for sure. So with the dropping prices, that can kick us into a claim. And then, like I said, some pretty serious quality issues when we got into harvest for some guys. So positive changes for 26. So a lot of good stuff passed in that big, beautiful bill as far as farmers were concerned. The first one, our ECL subsidy had gone from 44 to 65% last year. Now it's gone from 65 to 80%. And NECO went from 65 to 80% as well in this big, beautiful bill. So substantial reductions in premium, as I'll get into. New breaking, now all new breaking is insurable with no acreage limitations. Before we had to do a written agreement. And if we missed that by this March 15th deadline or September 30th deadline, you'd have uninsured acres because we didn't get the written agreements done. So eliminated that. Automatically it's 85% of the county average. That's a positive improvement too. And then acreage emerging from a USDA program, whether that be CRP or EQIP, you get it was 2 years to get that seeded to get 100% of the county average. Now you get 3 years. So improvement there. Native sod's now insurable the first year it's seeded without a written agreement. So that simplified things. All the other rules stayed the same in the native sod, which we'll review later in this presentation. So the big, beautiful bill. So what all changed in that for the better? We started showing you that and those subsidy increases, but another huge change is the beginning farmer rancher discount increased from 5 years to 10. There'll be another slide on this, but the first few years that you're a beginning farmer, you get very substantial discounts in the crop insurance too. So the PLC price increased from $4.95 to $5.45 on barley, $5.56 to $6.35 on wheat. It's been a while since we had to worry about PLC, but our commodity prices unfortunately have gotten low enough that these programs are going to trigger again. We're going to get a lot larger trigger on wheat than we have in the past because it starts paying at $6.35 a bushel. So as you'll see in the following slides, we're going to have some pretty decent PLC payments coming for the 26 crop year, and maybe some of the first ones we've ever had on barley that were substantial. So on the base acre thing, in that bill, they were supposed to give us a one-time chance to increase acres, not to exceed 30 million acres annually, I believe. So we may get a chance to reallocate our base. If you have land that was in CRP that you acquired from someone else and the base was stripped off of it, we probably will get a chance to add base acres back into that land now. And then if you're doing more than 50-50 cropping, a lot of the base was based on half crop, half fallow, so we don't have right amount of base to match up with our seeded acres. We should have a chance to increase that as well, and this would be, I think, per farm number. In some of our instances, it very well might end up being worse to actually add more base acres because they may make us redo our yields at the same time too. And if we have to reallocate our yields, we might have a 40 bushel wheat yield at the FSA, but through all these drought years now, Our average over the last 5 years might be 25 or something. So it's possible just ignoring this and leaving the base the same if they don't make us touch our yields. If that's the case, maybe our better option. But for those of you that were in wetter counties and we're doing more cropping, a real good thing. Or for you that have a farm number with no base acres, should be a real positive thing to get some base added back in there. Crop insurance subsidies, ECO and SEO went from 65% up to 80%, and then a 5% increase to some of the underlying subsidies, even in optional units. So pretty substantial difference. I know it doesn't sound like 15%. So yeah, what else is in that big, beautiful bill? For 2025, you automatically get the better of either the ARC or the PLC payment, whichever one ends up calculating more for your farm number. So that's a real positive. Almost certainly going to be PLC for most people because of the prices, but remove the SEO and ARC rule. So now we had some people in the past that accidentally would get an ARC at the FSA and be an SEO with us, and then it wouldn't get caught. Creates huge problems because you don't actually get a claim payment on the SEO side if that happens. So anyways, they removed that linkage thing so we can stack those two, which is a real positive. 100% bonus depreciation for the next 4 years. So you can buy equipment and actually generate losses on an entity if you want to, with some bonus depreciation. That's positive, real positive that was passed on. Pass-through entity deduction increased from 20 to 23%. So if you guys would pass through income from an LLC or an S-Corp, very well may receive a bigger deduction on some of that income automatically before your taxes are figured in it. Gift tax exemption went from $15 million to $30 million, and then the Section 179 increased to $2.5 million. So all really positive things for the farm industry. Your premium due date. So the RMA isn't offering an extension this year like we talked about at the beginning. It's actually due September 30th for most crops. If you don't pay it by September 30th, then they start tacking interest on. It ends up being about 16% interest a year, I think. So it's relatively high. If you're just out of operating money, though, and you want to let this ride along till the claim is finished, or you just need some time to get some grain sold, you cannot pay it on September 30th, and you have all the way till November 30th, technically, before it would cancel your policy, which we don't want to have happen. So wheat and forage must be paid by November 30th. The rest of it, the spring crops like barley and peas, could ride all the way to the spring. You're just going to have a fair amount of interest tacked on there, but it won't cancel your policy if you go ahead and just pay the wheat part and leave the rest, wheat and forage. So the other thing is forage seeding. So if you guys have any of that, if you seeded some alfalfa grass or something and that got put the first year on a forage seeding policy, that has a 9/30 term date because the billing date is like the 1st of July, I think. So that's one that can get you kind of caught, but the company warns us multiple times before we hit those trigger dates of where it would cancel your policy. The Farmer Portal is a great place to go within NAU or within RCIS to just get information like your balance on your account or maps for your policy or your old documents, like if you want to see your old schedule of insurance. Make a portal account, go play around in there. There's even all sorts of crazy things you can do within NAU, like field insights that will do weather predictions for your fields or imagery, and a lot of cool stuff that you just get for free that a lot of guys don't realize is in there. So the beginning farmer rancher, this is a very positive change. Now you must not have had an insurable interest in a farmer ranch for more than 10 years, where it was 5. So they stretched this out to 10 years worth of benefits. You can exclude when you're under 18, active duty in the military, you're going to college. So if your kids were on your corporation, for some reason you put them on there when they were in high school, but they were in high school, then college, we can exclude those years. Once they're out of college, though, if they're on that corp, they're going to begin racking up years of experience without getting this discount, quite likely. So the next thing is you need to fill out an app by the sales closing date. If you're not already qualified for the BFR program, we need to make sure we fill this app out by September 30th to get you into this program. This is where it becomes really obvious as to why you'd want to do this. So for the first 2 years, you get 15 extra points of premium subsidy. So if you're in enterprise units or SEO and ECO, those are subsidized at 80%. This means the government's going to pay 95% of your premium, or you pay a quarter of what your non-beginning farmer is going to pay for these programs. So third year, 13 points of subsidy, fourth year, 11 points. And then years 5 through 10, you're going to get 10 extra points of premium subsidy for these programs. So big deal for younger guys. At 10 points extra subsidy, that's still half the premium of someone that's not a beginning farmer if you're at 80% subsidy. So So here's just a slide comparing how these all stack up. So if you're a traditional farmer right now, your premium went down a lot too, because remember, you got increased subsidies in some of these programs. But you got $7.28 here. So this is a recrop winter wheat with a 31 bushel yield in this crop year. So $7.28 to be an ECO, SCO on revenue protection in enterprise units for this traditional farmer. If you're a beginning farmer that's got 5 to 10 years left in your experience thing, then you get 10 more points of premium subsidy. So you pay $3.64 versus $7.28 or half. If you're in years 1 or 2, you only pay $1.82 versus $7.28 because you're getting 15 extra points of premium subsidy. So if you have a kid that wants to get going in farming, the worst thing you can do, at least on this end of things, is add them in as a shareholder in your corporation, because your corporation has used up probably all the beginning farmer stuff. There's too many years of experience there. Every year they ride along as a shareholder in your corporation is eroding a year where you're not getting discounts in this stuff. Or the year you start them in the corporation, if you want them to be a shareholder there, start them on an entity on their own too, in an LLC or something where they're the only SBI, or them and their spouses, so they get the full benefits on the land that they're farming. But this makes it very attractive to transition some land into your children's names. Not only does that help the obviously the passing of the guard from one generation to the next, but that it's a discount is so substantial on some of these that it can add up to tens of thousands of dollars on a decent sized farm compared to a farmer that's not a beginning farmer. So if you're going to start out a child on his own, her own, make sure that you set an entity up that's completely separate from what you're doing, cash lease land to that or something, and then they'll have the benefits of the FSA being a beginning farmer, and then also get these benefits in the crop insurance. So how much of a difference did these extra subsidies make, even for us that aren't beginning farmers? So in 25, so you can see these are both 38 bushel summer, fall, and winter wheat units that I quoted here. A very similar base price for 26 as there was in 25, and that's because it uses the futures market about a year out from now to establish our base. So even though the winter wheat futures are substantially worse than that nearby, they're quite a bit higher farther out. So anyways, about the same, about $6 for the base. In 25, we would have paid $13 an acre to have revenue protection, SCO and ECO stacked, or yeah, 13 bucks. In 26, because we have all those extra subsidies, you can see the ECO and SCO are about half what we were paying. And then the revenue protection got a little bit of a bump in subsidy too. So $7.66 versus $13, a pretty substantial difference. So a lot of you guys are going to see premium reductions if you're in enterprise units and the 2 county programs that are going to cut your premium pretty much in half from what it was the prior year. So great job. Lobby groups, grain growers, all of those guys that helped us out on this, because that makes a substantial difference in our budget on a decent sized farm. This is really going to show up on high dollar crops like lentils and stuff, which are way more expensive to insure. You're going to see a large dollar shift there. So how can 15% increase in subsidy cut my premium almost in half? Well, this is a hard thing for people to kind of wrap their mind around, but really all we're concerned about is how much of the premium you were paying for before versus how much you're paying for now. So one example would be SCO and ECO were subsidized at 65% before. You were paying 35% of the premium. Now the subsidies increased to 80%, so you're only paying 20% of the premium. So the difference in what you had to pay before versus what you're paying now is actually the 20% divided by the 35% that you were paying before, or you're now paying 57% of the premium you were paying the previous year. So little bumps in premium subsidy, well, it doesn't increase the cost of this program a lot beyond where it was for the taxpayer, make a huge difference in the farmer paid in premium of this. Native sod breaking. So before it was uninsurable the first year without a written agreement, they took those rules away, so it's just insured the first year. The one thing that still is in effect on this, though, is it's 65% of the county average that you're going to get for that land for the first 4 years that you seed it. You also lose 50 points of premium subsidy just on the land that's native sod, right? And then so in that example, like if they took that much subsidy away, very well it would go from $10 to $20 an acre in premium. But the biggest thing is always talk to the FSA before doing any new breaking. It's becoming more and more sticky on trying to preserve native range or what's left of it. And if you have any maps that say SOD on them, or you're doing any breaking on land where you're not sure that that land was farmed before ever, make sure you talk to the FSA and you get a conservation plan put in place, because if you go do something to that and it wasn't approved, it very well could eliminate all your subsidies on these programs, at least for a year. So talk to the FSA if you're going to do any native sod breaking, as always. So CRP breaking, that just increased to 3 years from 2 years when it was coming out of the program. The other good thing is if we get past the 3 years, it becomes new breaking. But as we just discussed previously, the new breaking would be insurable without a written agreement, and you'd get 85% of the county average. So if we get more than 3 years from when it came out of the CRP program before we get this seeded, then you would end up at 85% of the county average instead of 100%, but it's not as extreme as it used to be. Oftentimes in the past, that might be a scenario where the stuff just wasn't insurable, period, if nobody knew and it got to be too many acres of new breaking. So CRP out after 3 crop years. Basically, like I said, after 3 years, it becomes new breaking. Get 85% of the county average. We no longer have to do written agreements to ensure that new breaking starting in 25, and remove breaking dates for 25. So the other thing was, in the past, if it was CRP breaking, there was no rule about when you had to terminate it versus seed it. Or if it was new breaking, you had to terminate that stuff. I think it was before the middle of November or something if you were going to seed it in the spring, or before July 15th if you're going to seed it in the fall. That's another thing that would get messed up sometimes with people, and then the stuff would be uninsurable as new breaking. So they removed those dates. They removed a bunch of the other nonsense with the written agreements and major improvements that the RMA actually gave us here in this. So added land, if you're under 2,000 acres, we can use the simple average of your existing units in that map area to create yield history for your new ones. If it's better than the county average, we can use your history. If the county average is better, we would use that. If you get over 2,000 acres, we don't have any option other than using the county average. So that's where obtaining the yield history from the previous producer, if it's better than the county average, becomes really important, right? So the share lease, if you do a share lease with someone for 1 year, it has to be a reasonable share lease, like a 75-25. It can't be a 99 and a 1%. We walked through that with the FSA before. But if you set up an actual reasonable share lease for 1 year, we can transfer the yields from the other producer to you, as long as that producer is okay with it. You can transition then back out of that share lease into a cash lease the next year, and you'll have all of that yield history. Now, one caveat with that is you also need to have access to that previous producer's records, because if you get spot checked by the RMA or have a high dollar claim, we need to be able to go back and prove up that production somehow. So if you're doing a lot of acres, taking land over from someone else, if it's over 2,000 acres of cropland, and cropland would be considered crop and fallow both, just whatever land you're taking over in those farm numbers, it's oftentimes advantageous to do a share lease the first year. Triticale or triticale is insurable in most counties. You can use production contracts to increase the coverage. There's winter and spring types, but it must be seeded first off with the intent for grain. So it needs to say on your FSA maps, not forage, but seed or grain on there. $5.17 a bushel for winter type right now for the base price. But if you can get a seed contract, even a conventional guy, where they'll tell you, let's say, hey, they'll buy this back for $10 a bushel if you're going to grow it for seed for us, we can use that to increase your coverage. Now, there are some things that the yields dropped in 25. I think the first year this program came out, in our map area, which is area 2, not the best part of Toole County, I think our recrop yield on this was like 38 bushels or something crazy. And now I think that's dropped off to the low 20s. So they corrected the yields that were incorrect the first year. So that kind of took some incentive away from using this. But if you're going to do it anyways, at least we can get insurance on it. There'll be no ECO or SCO, and there's no revenue protection in this program. But we can use contract pricing, which is a pretty big deal. Forage winter wheat grown for grain. This is a weird issue that not one of our customers, but one of my friends that I was talking to had, where he grew Ray winter wheat. If you look up Ray on the internet, it says that's a crossbred between Yellowstone and a forage winter wheat, and it was bred to be a dual purpose wheat. That's exactly how MSU advertises it. But in the crop insurance eyes, that still is a forage winter wheat. The forage winter wheat grown for grain is not available without a written agreement. So you need to get a written agreement if you're doing the fall type by September 30th. If it's a spring type by March 15th. So if you're doing Willow Creek or Ray or any of those forage varieties, even if their yields are good enough now that they'll kind of keep up with standard winter wheat, if you're going to grow it for grain and then maybe if you want to later hay it, that needs to be done under a written agreement. And then most likely the RMA will come back with a yield that is slightly less than what your current approved winter wheat yield is for that. So enterprise units by type. This is a big thing too that we always want to review. So in 2022, they changed it from enterprise units to enterprise units by type for wheat and peas. And this is a really positive thing. So we could put the winter wheat, the spring wheat, and the durum will all be kept separate in a claim scenario. But we have to seed 20 or more acres of each type then to make that work out correctly on the insurance. So same for peas, chickpeas, and lentils. It's not available on barley yet. So in barley, you're just stuck in enterprise units. And so that's going to throw the malt and the feed types together for your claim. Same premium reduction as before, and it's still subsidized at 80%, just like enterprise units are. But we need to have 2 sections of at least 20 acres per section of each type. So a section, the 2 sections could be in one field. We can farm across the section line, and that's fine. We just need to have 20 more acres in 2 different sections for this to work. So what can happen is sometimes people will seed winter wheat in 2 sections in the fall. Let's say we got 100 acres in section 1, 40 in section 2. You go out in the spring and you're like, oh shoot, I guess I'm just going to go throw 200 acres of spring wheat in for whatever reason. And you forget that you need to have 2 separate sections of spring wheat to make this work. If that's the case, it would automatically revert back to throwing the spring wheat together with the winter wheat and give you the enterprise unit discount, or we can pay the optional unit premium on that spring wheat. But ideally, you do this correctly, where you got 2 sections of winter wheat, 2 sections of spring wheat, both over 20 acres, and then that allows us to get that big discount on all those acres, but keep them separate for claims, right? So just want to always refresh our memories on that. Enterprise versus optional units. Why do we care that much about that? Well, as you can see, it's about 1/3 of the premium to be an enterprise versus optional. So it can be a huge difference. This is a 30 bushel continuous crop wheat quote from this spring. You can see about 1/3 of the premium there. Wheat's low enough, it's not a huge number of dollars, but if this was peas or something, it might be $25 an acre versus 8 or something. So it can be a really huge difference in what you pay in premium if we don't do this part correctly. So how's the malt barley endorsement work? A lot of agents don't want to sell this. They think it's not a good program. I would very much disagree with that from the loss experience we've had up here. We have a lot of malt growers, a lot of dryland malt growers around us. Even if you're an irrigated guy though, there's a very good chance you're going to get rain at harvest a year and get bad sprout. A lot of things can happen that will create claims on the malt barley endorsement end that you would not have gotten if you were in yield protection with contract pricing. And that includes the markets moving too, right? So here's a simplified example of how this works. But you have 10,000 bushels of barley, it all got rejected. You contracted your barley for $8 a bushel and you got $4 for it at the elevator for feed. So you got 50% of what you should have because it was feed, not malt. That means they're only going to count 5,000 bushels for your claim instead of 10. Obviously, that's going to pay you more money when they count less bushels. And then we had a revenue drop of about 20%. In simplistic terms, that means they're going to count about 1,000 less bushels on this claim as well. So you're going to count 4,000 bushels for your claim, even though you cut 10,000 bushels of barley. And that's how this pays you. Where if you were in yield protection, not only would you not get the price drop thing here, you would not get the yield reduction too. So I'm a huge fan of being in revenue protection in the malt endorsement and then putting that in enterprise units. Now, you guys may have reasons that you don't want to do that. Maybe you're a big irrigated guy with a whole bunch of pivots or something. You don't think that'll work. I'd be glad to run through scenarios with you, though, where I think that will work a lot better than being in yield protection in optional units in contract pricing as far as what your potential payout would be. So if anybody ever wants to argue this with me, I'm glad to have that argument, but especially if you're in enterprise units where they're paying such a bulk of your premium, this can make 6-figure differences in a claim really quickly if you grow very many acres of barley. So the other thing that can happen is, so if you're in yield protection and contract pricing, and that's how you applied your malt contract, you'd get this discount. This is on the feed barley side. So let's say we had 27% kernel damage. It was moldy and it sprouted and it added up to 27%. they're going to knock 36% of your bushels off for that. But if we're in the malt endorsement, we get to stack this on top of those other reductions. So remember, we went from 10,000 to 4,000 bushels. This would actually take us then from the 4,000 down to maybe 2,000 bushels. Where if you were just in yield protection, all you'd get is this one reduction, right? So it can be a substantial difference. I just wanted to point out we can use the malt side of the endorsement and then go back and use these charts also on the feed side if you're in the malt endorsement as well. Prices for winter wheat, so you can see we were at 710 and 22. Everything's rolled backwards a lot since then, right? So in 23, we actually hit 877 a bushel for a base price, which seems like something we can't even remember now, right? We would give anything for that. But every year we've rolled backwards. Every time it rolls backwards, it makes these county programs way more likely to pay as well as your own. So this year we went from $6 a bushel on winter wheat down to $5.05 for the harvest price. That harvest price is figured in August. So you are at 84% of where we started. Basically, in simplistic terms, they're going to take your production, take it times 84% if you want to look at it that way, and you can cut that many more bushels and still be in a claim, basically. So because they're going to value your production at less, your odds of having a claim go up. The odds of those county programs paying go up. Another reason to always be in revenue protection. For 26, winter wheat starting at $5.79 a bushel. That'll be your base price for this fall. We would think, hey, that should be way lower than that because we're at $5.05 on the harvest price. But remember, this is using a futures market that's a year out from now for the base price. So the futures is basically saying, hey, I don't think wheat's going to get great, but I think it's going to be better than it is now, which we all hope, obviously, is the case. Once again, your premium went from about $13 an acre for similar coverage last year down to $7.66. So really positive changes. Definitely should be in the county programs. I don't care where you're at now. They're paying a big enough chunk of this. There's no. So where did we end up on the other commodities? We already kind of reviewed winter wheat. It's down about 16%. Spring wheat's down 14%. And then durum actually follows the same market spring wheat does to set its price. So it's down 14% as well. Durum gets a little premium above spring wheat usually, so you can see it's about $1 a bushel right now above spring wheat. These would be the harvest versus base prices for the 25 crop year, right? Canola only ended up down about 2%, and then oats down 18%. Oats actually follows, I believe it was a wheat futures as well, just a different one, so it's down 18%. Flax is down 2%. The reason flax and canola match is because flax uses the canola futures to set its revenue pricing up and down. Revenue protection was just added to flax a couple of years ago, so if you guys have flax, I'd make sure you get that changed from YP to RP. And you can do enterprise units in that as well now. So review those coverages too. The spring is when we can, the last time we get a chance to change that, but I'd make sure you get your flax changed to RP. And then barley, this is the feed barley is down 19%. That follows the corn market, so that's why there was such a huge drop in that versus some of the other commodities. So if you have feed barley or malt barley without a contract, you would use that pricing then. And then if you have a malt contract, that market, that's based off the soft white wheat futures, I believe. And so that was down $1.09 a bushel. So how that would work is if you had whatever your average contract price was for the insurance that we use to get your malt price established, let's say it's $5.50 this year, we would just take $1.09 off of that for your harvest price, and that's what we'd use for a claim. So whatever your malt average contract price was, we subtract $1.09, and that's where you end up on that program. So why is revenue protection so important? So first scenario, price goes up in the spring. Price goes up at harvest. So in the spring, we started at $5 a bushel price for wheat. We have a 30 bushel guarantee, so $150 an acre that the insurance is guaranteeing us. We only harvest 10 bushels, so we're actually 20 bushels into a loss is how we would normally look at this, right? 30 bushel guarantee, 10 bushel harvest. The price though increases to $10 a bushel in August when they're doing the harvest price stuff for this. So the insurance does not care if you sold your grain for $5 or $10 at harvest. All it cares about is what happened with the futures market. So price increases to $10. That means your guarantee increases to $300 an acre. So the first thing they're going to do is go back and refigure what's the most we'll pay you if you get 0 bushels out of this. We're now going to use your 30 bushel guarantee times $10 or $300 an acre. you have 10 bushels of production to haul to the elevator. So the 10 bushels of production is valued at $10 for your claim, $100 of production. So we now have a $300 an acre guarantee minus the $100 a crop that the insurance considers that we harvested. We would, in this scenario, qualify for a $200 an acre loss payment because we're in revenue protection, even though we only started at a $150 an acre guarantee, and we still have 10 bushels left to sell. This sort of thing happens time and time again with revenue protection because the markets are so volatile anymore, right? In 21, we actually had a deal where the markets almost doubled because of the Ukraine war, and we hit that horrible drought. We realized some gigantic payments beyond what you guys paid premium on, even because the price ran up. So what happens if it goes down? That's the next thing. So a cool thing with how this is structured is that if the price ends up going down, we never drop in our guarantee. Remember, we can go up in guarantee when it goes up, but that initial guarantee we have never drops. So in this scenario, we're going to start at $10 a bushel. We have a 30 bushel an acre guarantee, and then which gives us $300 an acre for the guarantee to start off. Now here we're going to say we cut 30 bushels an acre. So if we were in revenue or yield protection, would we have a claim? We would not, right? Because we're not below our bushel guarantee. But because the revenue part gets factored into this as well, you're going to see what happens when the price drops. So we get to harvest, we're in revenue protection, the price dropped to $5 in the August futures. They do not care if you were smart and you forwarded contracted your wheat at $10 back here. The insurance considers it sold at $5. The 30 bushels you cut is worth $5 a bushel. Your crop's valued at $150 an acre for the crop insurance. And then you end up in this scenario with a $150 an acre loss payment, right? That $300 guarantee doesn't go down, but they're going to value the production that we cut at less. So another example of why revenue protection makes such a huge difference compared to yield protection here. It also helps out ECO and SEO. So if you're in revenue protection on your underlying coverage on your farm, you're also in revenue protection on ECO and SEO. If you're in yield protection, you don't get the price movement on ECO and SEO. That's even more important on the county programs because they're such shallow loss things that they can tweak. A 15% drop in price sometimes will make a huge difference in the amount that these programs pay. So this scenario, we have 36 bushel average wheat yield in the county, $9 a bushel for the starting price, or $324 of revenue expected for wheat in the county. The grain market declines to $7 a bushel. The county actually cut, we had a 38 bushel crop that we cut in the county. So right up front, you think, gosh, we had a pretty good yield. So there's no way SEO and ECO are going to trigger. But the 38 bushels in revenue protection gets taken times the $7, $266 an acre. That gets divided into the 324 we were expecting to get, and we're only at 82% of average for the county. So remember, at 82% of average, if you're an ECO, that covers from 86% to 95% on the county side. You'd get all your ECO money. And then we are part of the way into the payment on SEO as well, right? Because that would cover from our 75% level, if that's what you're at on the underlying insurance, up to 86%. So what happens if on SEO we only get down to 82%? Remember, we'd have to get to 75% to get all our money in that scenario. So we're at 75% level in revenue protection. SEO covers that gap from 75 to 86%. So 11% gap that's insured. Our 86% trigger level for SEO for the county, that's where it'll start to pay. That's just established. The county came in at 82%. So we're 4% below the trigger level. That doesn't mean we only get 4% of our SEO payment, though. What that means is we are 4/11ths of the way to getting all the money out of it, right? Or we take 4, divide it into 11, which is the percent gap that it's covering. That means we get 36% of our SEO payout in this example. So hard for people to wrap their minds around that sometimes, but it can make a huge difference in payments, just little percentage blips in those county programs. So it's a quick review. ECO and SEO stack on top of your individual insurance. They're triggered on the county level though, so it's more of a disaster program. PLC is going to stack on top of that, or you can be in ARC now and stack that on top of those. In the past, if you were in ARC, we had to eliminate the SEO portion of that. So how is that paid through our agency? It's paid every year in Toole County. Actually, this is through our agency as a whole. So every year it's paid back way more than people paid into premium, except for 2020, which was a pretty good year in a lot of the counties. So there was some payback on that, but not a lot. As a whole, well, I can't see it because my face is here, but I think there was like $3 million of farmer paid premium on the premium side and $13 million paid out. So since 2015, as a whole in our agency, because it paid a lot in these last few years, there's been about $12 million of farmer paid premium just through our agency paid in this, about $42 million paid out. So huge amount of money injected into our economies in some poor years. The other thing I would like to maybe stress here is that because the subsidy level got so high in these programs, one of the intents with raising that subsidy level was to get everybody enrolled in this in a program where they're all paying something in for a disaster program that possibly would pay out in the future. And it's very possible this is going to replace things like SDRP or ERP, and this will be your disaster program. So I think there's a possibility if you don't enroll in these and take part in this. We already saw that in the SDRP. That allowed the SDRP people, it could trigger a full SDRP payment, plus you could have got all your SCO and ECO money. So for the guys that were in SCO and ECO, a lot of you got that money. It didn't take anything away from your disaster program payments, and then you were kind of able to double up in that scenario, where I think going forward, there's a reasonable chance there won't be SDRP or ERP payments, and this is going to be your disaster program. So I do not see any logical reason why someone wouldn't enroll in this. I don't care if you're irrigated, dry land, or whatever now. The subsidy rate's so high that your odds. So one thing that's affecting our SCO and ECO stuff is all these years of drought and the county yields. And so as you can see, Toole County started at 38 bushels about 6 years ago. As we hit these drought years, it started whittling away at these yields. So now we're down to about a 29 bushel average in Toole. Similar thing happened in Liberty. We're down to 32 bushels there. But in the counties that have had decent crops, like Pend Oreille missed a lot of the drought that we were in. Their yields actually held steady or actually slightly increased there for a bit. They're starting to kind of see some reductions. But if you're in one of these counties where you say, well, God, SCO and ECO is never paid there, your odds of it paying are much higher in the counties where it's never paid because the yields have increased than it would be in these ones that have had a lot of payments. That being said, 29 bushels even still is pretty good for Toole County, I think, as a whole. So we can't fix this part. The only way to fix it is to break this drought cycle. We hope we're getting out of it, and we have some years where it doesn't pay, but it's cheap enough now. I would stay in these programs because between revenue drops and some drought years, you're very, very likely to get your money back, which you'll see in the following slides. So margin protection, this program, very good idea. It takes into account input prices and your yield and revenue, and could trigger a claim for you on your individual side. The problem with it right now is it's spring wheat only, so that doesn't fit very well for a lot of guys. It doesn't stack on top of multi-peril like ECO and SCO. So if you have an underlying claim, like a yield claim and then a margin protection claim, the yield claim subtracts off of what they could pay you on the margin protection. So that really takes away from your odds of getting a decent sized payment out of that. Great idea. If they make it stackable or they subsidize it higher, then that might make that program more attractive. Now there is another program that's coming out called Margin Coverage Option, and this is county-based margin protection. And I could see this actually replacing ECO eventually. This has an 80% subsidy rate. It covers that same gap from about 90%, let's say 86% up to 95, I think. But the neat thing about this is it's kind of like ECO, where it uses the county's average yield and then whatever was actually harvested for the county for an average yield, whatever happened with the revenue prices, but also throws into the mix inputs. So fertilizer and fuel and things like that would potentially trigger this if we had a big run up in inputs. So what it looks like this is headed towards is maybe this replacing ECO, and then have an SCO for kind of some of the deeper shallow loss type stuff. But right now it's spring wheat only, so it's kind of a mute point for most of our area anyways. Important note on disaster programs, must be MPCI, not ARC to be an SCO. They actually removed that requirement. So now you can be in ARC and SCO or PLC and SCO like we reviewed. SCO and ECO don't pay out till May the following year. So that's one kind of caveat of these programs is it takes a while to get all the yield data in there before they can be paid out. And there's oftentimes claims that get drug out until the spring of the year, and they want to finish up as much of that so they get accurate data before they pay this out. So our county is the least likely program to pay right now at the FSA. That could change in the future if the price goes up. So if we end up with like wheat average price at $8 to $10 for multiple years, and that ups that Ark County price, that'd make it way more likely that pays in PLC, because PLC would be above the trigger level too, right? So, but for now, stick in PLC. As prices change every year, we'll just do another presentation, and we'll let you guys know when we think it makes more sense to mix that with SCO, the Ark side. So what's PLC going to pay right now? Your wheat base got moved up to $6.35 on that from what was $5.50 a bushel in the big beautiful bill, which is a positive. The average nationwide average wheat price right now is running at about $5.30 a bushel. So $6.35 minus $5.30 is $1.05 a bushel that you'll get paid in that program. And the next slide, I'm going to review how that would pay. So barley too, sorry I skipped past that slide, but the barley right now is set to trigger about a 15-cent a bushel payment, which is unusual for barley because the price was too low to trigger prior, but they upped your PLC payment price on it as well. So how would this pay? Just quick refresher, since we haven't had to worry about this with the commodity prices for a while. You have a $6.35 a bushel trigger in PLC for wheat. The market, your average price right now is at $5.30 a bushel. That would mean you'd have $1.05 a bushel payment for the 25 crop year for wheat. Remember, that doesn't finish calculating till May 31st of 26. So there's going to be more months of wheat sales that are going to get put into this, and that's only going to, if things stay the way they are, drag that number down, because the cash winter wheat bid at our elevator up here is $4.20 or something right now. So there's a lot of wheat sales happening in that sub $5.30 range. It's going to drag that down. So it's very possible we could end up at $5, let's say, on the PLC. But for this example, we have $1.05 for the trigger, as far as how far deficient it is. Your FSA yield for farm number whatever is 40 bushels an acre. And remember, each one of your farm numbers will have a different set of base acres and different yields for certain crops. So in this example, we have base acres of wheat. It doesn't matter on that farm number if you seed it at all to lentils, you're going to get paid on wheat when this triggers, if that's what you have for base. So 40 bushels an acre for your wheat yield on farm XXX here. You have 1,000 base acres of wheat. It'll pay on 85% of those acres, so 850 acres is eligible for payment. So the 850 times the $1.05 payment rate times 40 bushel average, which actually ends up being $42 an acre payment, means this farm would get a $35,700 PLC wheat payment there. These are pretty substantial payments. A lot of you guys probably have half the base of what you have for cropland at least, and if you take that times 40 bucks even, it could end up being a lot of money. So the problem with this is the payments don't come till the fall of 26. So how does ARC pay? Very similar to SCO, but the problem with ARC is if the price goes up. So if the ARC benchmark price right now is set at $6, let's say, then wheat runs up to $8. Your guarantee doesn't go up along with that, and so it actually takes away from your loss. Where on SCO it doesn't work that way, right? The max payment rate right now for ARC for Toole County would be $19.58 an acre, and we would have to have enough yield loss and a low enough price to trigger that. It's possible that would happen, and if it does happen, you're going to get the better of either that or PLC, remember, for 25. But most likely, looking at how far deficient we are in the wheat price, at least your wheat base is going to pay better in PLC than it is in ARC, I think. And then for next year, I would select PLC because at least that's a no, and we know unless the wheat market really turns around that that's probably going to trigger a payment, where ARC is more of a wild card based on what happens with yields and prices, right? So should I consider stacking ARC with SCO? And I think so. I mean, I think you need to in the future. Right now, PLC makes so much more sense because the prices are in the tank, right? If wheat gets back up and it seems like it's going to sit there kind of level at $8, let's say, we know you're not getting a PLC payment probably in those years. So in those springs, when the FSA wants you to pick a program, ARC would make more sense, and especially since we can be in ARC and SEO at the same time now. So we had one of the largest drops in net farm income ever between 23 and 24. That obviously caused a lot of stress here because inputs went up at the same time, right? And so will we get any disaster money? Well, you already got SDRP and the payment prior to that, the flat rate payment. But because you're not going to get that benefit from those increased PLC prices and stuff until the fall of 26, there is now talk of what's called the bridge payment that the USDA may be going to issue too. So I have no idea what sort of structure this would be in. In my mind, it'd probably be more of a flat payment like the last one was, where at least it pays the corn guys so much an acre and the wheat guys so much an acre, just to prop the farm economy up. Because we're teetering on the edge of where there can be some pretty major problems in parts of the country here with the farm economy, with the prices this far suppressed. SDR Stage 2, the rules on that will be issued in October, so we'll have a clearer picture of that. But assuming it works like the last ERP program did, it's going to basically be the shallow loss stuff. So if you had in 23 or 24 yields that were just above your crop insurance guarantee, so you were just kind of in that gap between 75%, let's say, and 92%, that's where this is going to fit for you. Through our agency, we're going to be able to kind of data mine that, I think, and flag the guys that should at least look at applying for that. Could end up being quite a bit of money if you were just right on the cusp of having a crop insurance loss but didn't have one. So that could be money that you could look forward to coming. And then obviously there should be a top-up payment on that SDRP Stage 1 that we got once they finish the Stage 2 process, because they'll know how much money's left to dole out. The big thing is, though, this bridge payment very well may be coming too, I think, at some point this year. There's a fair amount of chatter now of an extra disaster prop-up. So for you guys having a really tough time financially, I think there's a chance there might be some more money coming your way. ECO and SEO payments for this year, super hard to predict because these counties were so variable in yield. It's much different if there's a county-wide drought. In Tula County, we had everything from 80 bushel barley in areas to 10 bushel barley in others. And so until we get all your production reports in here at our agency, we're going to have a really hard time guessing this. But if your county was in a drought in wheat, the price dropped enough, it's probably going to trigger at least an ERP payment, I think. If you're on the cusp, like Tula County, we won't know until we get the yields all in. We'll know for sure on this when we get all the way out to the payment date in March. But we have enough of a sampling of Tula County within our agency that as soon as that production reporting is done, November 15th, they'll give you guys a much better guess on whether this is going to pay or not. Remember, crops like mustard, flax, and other specialty crops oftentimes use multiple counties or the whole state for their yields. Those are even harder to predict. So those we just kind of have to wait on unless we know the whole state had a disaster, right? You'll get quote sheets from us if you're one of our customers. Basically, anyways, on there it shows you'd stack the ECO, SEO, and revenue protection usually is where we would have guys here. So we would add those three things together. 75% is the most common. Reason for that is on this sheet, you can see if we jump from 75 to 80%, a whole bunch of the subsidy goes away, and it basically doubles your underlying premium on the revenue protection. So it doesn't jump a lot from 70 to 75, but it jumps a lot from 75 to 80. So I think you're better off, at least in Montana here, being at 75% in enterprise units if you can make that work, than stacking ECO and SEO now that the subsidy is so high on those things. So what are the odds of these programs paying? ECO, so it was $4.97 an acre for $28 worth of coverage last year, basically. That now went down to $2.58 an acre for $20. So it went from needing to pay every 4 years to needing to pay one out of every 8 years to break even on your premium. 50-50 chance this program pays roughly every year because it starts triggering at 95%. So almost guaranteed statistically that you're going to get way more money out of this than you pay into it. Also remember that $20.50 could double if the revenue price went up and we had a drought, right? So that completely throws another wrench into this where it might be, hey, this only needs to pay one out of every 12 years or something if we put that into the equation too. So SEO was a good deal anyways, but now they dropped their premium a bunch for the extra subsidy, so now it only needs to pay one out of every 11 years instead of one out of every 11 or 12 years. So no brainer on that as far as some place to put money. If you hit a year where we hit droughts, this program makes a huge difference between having a loss financially on your farm and breaking even. Revenue protection, that one's a lot less likely to pay all the way out, right? Because you have to get to zero, but it happens. Like you guys might get hailed completely out. That only needs to happen 1 out of every 28 years on that program to pay back your premium versus what you could get out of it coverage-wise. So all of these things are gifts from the government. You should enroll in as much of this 80% subsidized stuff as you can, because your odds of getting your money back are astronomical in those programs. So stuff like optional units on wheat, that's getting harder and harder to justify because the subsidy rate's so much lower, the premium's so much higher on there. I understand there's reasons for optional units, but you can on your farm do a lot of planning by shifting crops around so that each crop type's in a different area on your farm to limit the risk. Or if you're a giant farm, split it into 2 entities, and then that gives us a lot less risk of having all those acres, let's say a wheat, into one entity. But the discount is so substantial on this over years, it adds up to a lot. I really like enterprise versus optional units in general. So, and remember, like I said, your coverage can increase up to 2 times what you pay premium on in these revenue protection programs. So most important slide of the day, must use your full legal signature on documents. They got a little more lax on that, but just keep doing what you're doing at the FSA. Don't wait to turn in a claim if you have one. That's the number one way people have mistakes. And then don't let your adjuster throw production together if you have records to separate it out. There's still legitimate reasons, even if you're an enterprise unit, to keep things as separate as we can in the farm. So do that. Strongly consider ECO and SCO with market and drought conditions and with the extra subsidy. Never ever take YP on something versus RP unless there's a very solid reason for that. And really one of the only solid reasons would be if you're an organic producer, wants to use a contract for feed barley, because that's the only way we can use your contract pricing on barley. There are some weird times in organic, especially where we can use a higher contract price for some reason on YP on chickpeas than we can in RP. That's a year-to-year thing. But in general, being an RP is way better because it triggers the county programs more consistently too. So enterprise units by type makes putting wheat into enterprise units much more appealing. And so make sure you're in ET, not EU if possible. Always elect PLC at the FSA. The prices are low enough, we know PLC is going to pay now. I'm not going to say always anymore on that, because we did that because you had to be in PLC to be in SCO. Now that you can stack SCO and ARC, there are going to be times that ARC's going to be better than PLC, but now isn't that time. So what do you suggest? 75% revenue protection, still the best value in EU, and consider 70% if you're in optional units. Take ECO and SCO on all the crops. The subsidy rate makes it a no-brainer. PLC at the FSA until prices rebound, and once they do, I would seriously consider switching to ARC. And then seriously consider LRP if you're a cattle guy. That there's a few things that are just absolute greed. If you don't put a bottom on that market and you miss out on this thing just because you didn't want to give up $30 a head, let's say, on your cows to secure possibly a $3,000 calf, look at LRP or look at some kind of marketing. It might be hedging. I hedged this year on cattle, and it actually, we lost a fair amount of potential profit on that because I hedged and didn't do LRP. So we put LRP on as well. I put a hedge on. Don't do that. Put LRP on it. Let that be the bottom, and then you can always take the whatever it runs up to. That can be your top, right? So I think that kind of covers where we need to go through with you guys. There's a checklist. If you're one of our customers, we'll be calling you to go through this checklist if you weren't at the meeting. So I won't review this on these slides, and just thank you so much for listening. If you have any questions, as always, give us a call. But lots of changes, lots of stuff for the positive, and I sure appreciate you guys taking the time to listen to this.